at the top end of the market cap scale with those big US tech companies, they have the potential to be really more volatile than their the previous generation of the biggest companies in the world would have been. That's my sort of opinion, that's my read on it. I think from one sense, I'm upping the risk and the volatility, but actually I just think I'm replacing something that was also potentially quite volatile as well. Hello everyone and welcome back to the Personal Investor Podcast. I'm Ed Monk and I'm joined today by Fidelity's Jemma to talk about the fund choices that we've made inside our ISAs this year. We'll run through each of our choices, why we've chosen them, but also pull them apart a bit so you can see if they make sense. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like and leave a comment if you want. And once you've subscribed, remember to hit that bell icon at the top of the page to turn on all notifications to make sure you get new content as soon as it is released. That all said, Jemma, welcome along. How are you?
I'm very well, thank you, Ed.
Whenever we talk about specific investments, Jemma, we need to make sure that people know that none of this is personalised financial advice. These are not recommendations to buy or to sell or to hold any of these fund choices. It's simply how we're doing things inside of our own investing. Jemma, why don't you start, for anybody that doesn't already know, what are ISAs and why are many people thinking about theirs at this point in the year?
They're basically a really, really tax efficient way to save and invest your money. So you can invest up to 20 grand a year in an ISA, and any returns you make on that, any interest you make will be completely tax free. And people are thinking about it at this time of year because the 5th of April is rapidly approaching. So tax year end is coming up. So people are thinking, well, do I want to put a bit more in my ISA to really make the most of it? And they're thinking about what they want to do next year to really put their money to work and make the most of a really useful sort of investment account, really.
And £20,000 allowance each year. You get a new allowance as soon in the next financial year as well. But there will be people who sort of completely use up their allowance, the lucky few, because they've got the money to do that. If they haven't already used their allowance and they have the capacity to do it, it's always sensible to do that. Okay, so let's get to our choices now. We've both written articles about these choices, and I would urge everyone, if they're interested in reading them, to find them. Just follow the More Insights link in the description of the show, and you'll be able to get those articles. But let's run through them now. Now, as it happens, I've chosen 5 funds for this year and you've chosen only 4, Jemma. So if you don't mind, we'll start with one of mine and then alternate and then we'll get through them that way. So the first of my choices is the Fidelity Global Dividend Fund. I'll just say a bit about it. It's a global equity income fund. It's looking for those companies that pay dividends. My rationale, I suppose, is that, and this is going to be a through line in a lot of my choices, I'm diversifying away somewhat from the very largest US companies. Largest companies tend to be in the tech sector, don't pay dividends. So the fact that this fund looks for dividends means that you're kind of excluding them by and large. It also underweights the US relative to other global funds, more UK, more Europe in particular. And it's produced a really, really steady ride for people. It has risen, but past performance is no indication of what's going to happen in the future. However, I'm attracted to that sort of steady rising return from, as I say, companies that are well established, paying their dividends, churning out profits for their shareholders. So what do you make of my choice?
Seems very sensible. I was looking through the portfolio today and I noticed there are a lot of European companies, as you said, and quite a lot of UK ones. And I wondered, did that play like a big role in your thinking? Do you want exposure to stuff closer to home?
Well, funny enough, the Europe exposure, yes, it's almost, I don't have a dedicated European fund in my investments. I don't actually have a dedicated UK fund at the moment either. And so, it's kind of standing in for that a little bit when looked at in the round with other things I hold, a nice kind of more even global exposure. And, dividend paying companies aren't always good value versus the market. Sometimes they can be expensive versus the market, but as it happens just right now, they are quite good value. So I'm kind of reassured by that as well for that reason.
Nice.
Okay, so let's move on to your first choice, Jemma. It is the Fidelity Index World Fund. It's just a coincidence, by the way, that these are 2 Fidelity funds. There are some non-Fidelity funds we're going to talk about, but the Fidelity Index World Fund, the most vanilla of the vanilla. Why have you chosen it, Jemma?
So this was my very first investment I ever made, and I've stuck with it. I think at the time when I was deciding to buy in, my reasoning wasn't super sophisticated. I basically wanted something that offered exposure to lots of different countries around the world and didn't charge really high fees. So I was like, a world tracker fund ticks that box.
Yeah.
I also didn't want to be too clever, really, because I thought if I try and like home in on a particular theme or a particular country, that could easily backfire. So I just thought I'd go for something vanilla that offers fairly broad exposure. I think today that reasoning still holds up, to be honest.
Yep.
I'm thinking that money is going to be in the fund for the long term. I can sort of relax about it. I'll just ride the ups and downs of the market. And I've got it so a bit of money goes in every month. It runs itself, and I try not to worry about it too much. So it is, as you say, my vanilla fund for thinking about later.
Yeah, and look, lots of people who approach their investing in the same way. I'm quite similar to that as well. I kind of agree with all the points you make there. I mean, in a way, this fund, on funds like it, they're like the cheapest, easiest way to invest in the kind of the global stock market, right? It's kind of, I think this is true to say it's actually the cheapest fund of this type tracking the global market that certainly is on the Fidelity platform. There's cheaper ones tracking individual markets, the UK and the US, but in terms of global trackers, it's just about the cheapest you can do. And I just think it makes loads of sense. And presumably, well, I don't know, many people would use this as a kind of core holding. You know, it means you're sort of automatically diversified. You can adorn that with sort of bits around the edges, but that's a kind of real central holding.
That's how I've approached it. And one thing I didn't really know when I first set out in investing, that actually global tracker funds can look quite different depending on which one you go for. So there are other options out there where, for example, you might get more exposure to emerging markets. Maybe you'll pay a bit more, but you get more diversified sort of portfolios. So there are different things you have to think about. But I thought that Fidelity World Index covers the core stuff that I want.
Well, yes, and well, it's interesting you say all of that because it leads me on to my next choice, which is also a global index fund, and actually is one of the ones, as you mentioned there, that's basically a little bit more expensive, but it is tracking in a more sort of into further reaches of the global market. So this fund is called the Vanguard FTSE Global All Cap Index Fund. Snappy title, but what that means is it's covering the whole sort of market capitalization range, which basically means companies of different sizes, including many more smaller companies. That appeals to me. The higher emerging market allocation appeals to me as well. I said that I'm sort of tilting away somewhat from the largest US companies. This fund holds about 60% in the US, so I'm still going to get my fair share of those companies, I think. But that probably compares to about 70% in the fund that you've chosen, for example, which is sort of more developed markets and just so skews to those larger US markets a little bit. But similar rationale beyond that. Cheap-ish. I think this is 0.23% as an ongoing charge versus 0.13% for the one you looked at. Yeah. That matters a little bit. You know, I'm going to kind of give up something there in terms of what I'm paying, but I'm happy to do that for those other perceived benefits. Right, your next choice, Jemma, a very famous fund, Fundsmith Equity. Why have you gone for it?
So I went a bit rogue this year. So this is a new fund for me. Obviously, it's a very famous one, but it flies in the face of everything I was trying to achieve with the index fund, really. So before I was looking for low fees, broad exposure. Fundsmith is an actively managed fund. It's got a relatively hefty ongoing charge and it has a very concentrated portfolio. So it's only got about 29 companies in there, I think. So you're really being committed to, you know, the portfolio of stocks that have been picked by Terry Smith.
The fund manager. The very famous fund manager, actually.
Yes, exactly. So the reasoning behind that was I was looking at my World Tracker Fund and I was getting a little bit nervous because while I was using it to get lots of nice broad exposure to different countries, as you've alluded to, it was actually getting very, very US heavy. And within that, it was just a handful of tech stocks that were massively driving those returns and sucking in that capital. And I was thinking, well, if the narrative changes a little bit, this could be quite nasty, at least in the short term. And I thought as all the generative AI story starts to emerge, things feel more volatile than they did before. So I was thinking, I want to diversify away from those US juggernauts.
Yeah.
So I looked to Fundsmith and I thought, actually, the stock picking process really resonates with me. He is basically trying to find quality companies. And by that, it means companies with really strong fundamentals. So they might be able to generate better return on capital than their rivals, have better profit margins, be able to turn their profits into cash and grow that cash. And I just thought, over the long term, it makes sense to me at least that those sorts of companies will eventually outperform the market. So I decided to give it a go.
And it's a rationale which lots and lots of famous investors have pursued. I think Warren Buffett might say something similar, although he's had this sort of value approach, whereas Terry Smith and the Fundsmith Fund doesn't mind paying up for this quality, does it? It's if you look at the valuations of the fund versus the market, it's a little bit higher because of this quality. That's what they tend to go hand in hand, don't they? The quality fundamentals, you tend to have to pay up for them. But you're reassured, you're convinced by the kind of rationale by that.
I think so. I mean, it's worth saying that the quality approach has had quite a rough time recently, and Fundsmith itself has been struggling a little bit versus the benchmark over the last few years. So valuations aren't looking like really eye-watering compared to some of the stuff you see in, for example, the US tech sector. And it feels like maybe we're at the point after this period where quality has struggled quite a lot that we might see this resurgence, because so far this year, we've seen a bit of a rotation in the US stock market where these really big tech firms are actually underperforming slightly compared with other sectors. So it feels like change might be in the air. And I guess the quality arena feels like an antidote to some of the worries that we've seen elsewhere. So, for example, like AI getting too excited, low quality companies attracting too much investment.
Yeah, just finally, before we move on, a really, really concentrated portfolio. I mean, you might get active funds that hold 50, 100, almost 200, companies within them. 29 is very, very concentrated. But that does mean you have a chance of kind of moving the needle sort of thing. You're not just going to replicate what you've already got in terms of tracking investments. I'm going to move on, Gemma, to my next choice, if that's okay. And for me, it's an exchange traded funds. So just to explain that a little bit, it's rather than a mutual fund that you buy units in, it is itself an instrument which is listed on the stock market. So it kind of trades like a share, but it does not invest in companies. It is the iShares Physical Gold ETC. It tracks the gold price, basically, which is what I want it to do. Gold, I've been on a journey with gold, and basically I in a way I still do buy all the arguments why you shouldn't ever buy gold. It doesn't do anything, it doesn't produce anything, it just sort of sits there and looks at you, whatever that famous quote is about gold. However, experience tells me that it does sometimes really, really, really help. I don't hold it in very large amounts. I hold it as a hedge just for those times when everything seems to fall and gold can make these strides. Now, it's done that recently, and I'm going to say, within the safe space of the pod, I've missed most of...
I was going to ask when you decided
I sadly
to buy.
have missed most of the upside for gold, but I get the case for it. And honestly, it's probably an age thing, because it's I still believe and hope I've got most of my sort of contributing to investments ahead of me. And normally that would mean you really don't mind market falls, because that just means you could get to pile in more at lower prices. That's good for your long-term return. But that is changing somewhat as I kind of move through life, and actually protecting on the downside a little bit is quite reassuring. And I think having gold in my portfolio gets me more comfortable with some of the other risks I'm taking. So that's my case for it.
Was there a reason you chose the physical gold ETC rather than like a fund which invests in gold miners?
Yeah, there was this time. I mean, previously I have bought a fund like that. But if people don't know what happens with the mining shares, it tends to kind of amplify movements in the gold price. So if the gold goes up, great, you're really going to benefit. But if it goes down, you're really going to sort of feel that as well. I just don't want to take that extra. That felt like an overlay of risk on top of just what the gold price is doing. And actually, I want the gold's ability to move differently from other assets. Not that it always will do that, but it does clearly have that ability. That's what I want. So
Makes
hence
sense.
the physical gold ETC. Okay, your next choice, or at least a contender in your portfolio, Gemma, is the BNY Mellon Long-Term Global Equity Fund. Another snappy name. Where do they get them from? Why do you like that fund, Gemma?
I think the logic's very similar to Fundsmith, really. I was looking for a way to diversify my portfolio. And again, this fund has a quality focus. So it's trying to find those companies with really strong underlying fundamentals. So I
Yes.
thought I would throw that one in the ring, see how it does. And that's basically why I was just looking for something active where companies were being cherry picked based on, the underlying strength of their performance.
Yeah, and again, it's that sort of focus on the quality, and I think that's reassuring actually as well. I do kind of get that case, particularly you're younger than me. You've got this long period of time ahead of you to kind of get in early in what should be high quality companies, as you say, not at the highest valuations they might be, and just to hold that for a very long period of time to see what those companies turn into in the future, having probably already been around for a long time already. That feels quite a kind of like shrewd move.
I hope so. I mean, go back to the Fundsmith portfolio, as you say, the companies do tend to be relatively old, so they've withstood the test of time a bit. And just personally, I don't love the idea of chasing trends, like trying to play the market. I'm not that sort of investor. I don't want to be that involved in my finances every day, really. So I'm
Hmm.
looking for something where I can feel comfortable investing for a long period of time and not think, oh gosh, I've completely missed the boat on that, or I've missed this short term blip in the valuation, so the investment case is gone. I want more long term than that.
Okay. Okay. Well, that one is long term. The clue's in the name. I'm going to lump two of my next choices together, if that's okay, Gemma, because the rationale for both of them is quite similar, even though they are quite different funds. Um, I'll say again, I want to diversify somewhat away from US tech. And it occurs to me in this sort of environment, and actually, I think we've seen this in the past year or so. I think people are seeking out once again the more traditional sources for growth exposure within portfolios. For so many years, US tech has given us that. And you haven't had to look anywhere else for like higher growth potential. But emerging markets and smaller companies, to me now, feel like the places to return to for that kind of hoped for higher growth. So I've gone for two passive options. Again, we've got the Vanguard FTSE Emerging Markets ETF and the Vanguard Global Small Cap Index Fund. One's an ETF, one's a fund, but they're both run passively. What do you make of it?
Would you say that sort of dials up the risk in your portfolio a little bit? I'm just thinking smaller companies, emerging markets tend to be at the riskier end of the spectrum than, very large developed markets. Was that sort of a conscious choice?
Yes, it is. I mean, all of these choices are equities, so in one sense, they're kind of all at the higher end of the kind of risk spectrum. But yes, smaller companies for sure, emerging markets for sure. They come along with higher volatility. Um, I think it's just the case that actually at the top end of the market cap scale, with those big US tech companies, they have the potential to be really more volatile than the previous generation of the biggest companies in the world would have been. That's my sort of opinion, that's my read on it. And so I don't mind. I feel like you're right. I think from one sense, I'm sort of upping the risk and the volatility, but actually I just think I'm replacing something that was also potentially quite volatile as well. And volatility is the price we pay, I think, for the potential for higher returns. So I don't mind that. Don't mind a bit of it. I've got those dividends in there as well. So balancing things out in that way. Rightio, the last choice today, Gemma, is yours. It is the Rathbone Global Opportunities Fund, another high conviction fund. So why'd you pick it?
It is, again, sort of that quality focus, experienced investment team, good track record. I thought it's worth seeing it as a contender. Very different to other investments I've made, as I was saying. So I thought I'd give it a go.
Yeah, and this fund actually does or has historically been very happy to back highly valued big tech names from the US. Kind of made its reputation almost on doing that. But it's active, and that means that there's a manager, James Thompson, there to look at where things are too stretched, and they can make that call and back away from some of those names. Being active in that space kind of makes a lot of sense to me.
I think so. I find it a bit reassuring that there is someone there willing to make big calls to shake up the portfolio if they think it's necessary. And obviously with the passive fund, you just, by its very nature, won't have that. It's just going to track whatever happens in the market, however that unfolds.
Yeah, and just finally, I think what I think is a kind of nice theme in all of your funds is this concentration, because you've got that core of a passive option. So the stuff you have to accompany it needs to have some punch and needs to actually make a difference and be different from what's in the index. So I think your choice is do that. Okay, well, that is all the time we have for now, Jemma. I will say again that if you want more details about the funds that we've chosen, you'll find those by following the More Insights link in the description of the show. Please subscribe to the channel, hit the bell icon to get notified as soon as new content is released. That all said, Jemma, thanks for joining me.
Thank you.